Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Massar and Tim Stenovec from Bloomberg Radio.
We do have U.S. bonds climbing, disappointing factory data, declining consumer sentiment, solidifying some of the bets that are out there on interest rate cuts, with traders also sifting through the latest remarks from a slew of Federal Reserve speakers. There's been a lot this week, Tim.
Yeah, in particular, U.S. two-year yields extending their slide after Federal Reserve Governor Christopher Waller said he would like the central bank to boost its share of short-term treasuries.
Yeah, and traders slightly boosted their bets on a Fed rate cut come June. All right, our next guest, though, says the Fed will not cut rates in 2024, joining a growing chorus of Fed watchers from former Treasury Secretary Larry Summers to Wall Street strategists over at Citigroup. So his note to clients, it's all in a story that is among our most read. I think it's number 3 right now on the Bloomberg, but it's been atop the list for most of the day. Let's get to our interview, and we welcome back Torsten Slok. He is Chief Investment Global Management Chief Economist and partner over at Apollo Management, and he joins us from New York City. Torsten, so great to have you here with us. So why will the Fed not cut rates this year, or why shouldn't they, in your view?
I think if we think about what's going on at the moment, let's look at financial markets, of course, as much as they have eased, and then ask the question, is it really surprising that the employment report was so strong in January? Is it really surprising that inflation is beginning to show signs of moving higher? Because think about it, since the FOMC meeting on December the 13th, we have seen a significant rally in the stock market. We are basically all-time highs every day. We've seen significant tightening of IG credit spreads, of high-yield credit spreads, of loan spreads. You've also seen significant issuance of IG bonds. January was the biggest issuance in the history of January's going back in time. You also had high yield issuance has been strong, loan issuance has been strong, and finally you've also seen IPO activity has really started coming back, and M&A activity has also started coming back. So with this very substantial tailwind of easing in financial conditions, it is really not surprising that we should begin to see more tailwind to employment, more tailwind to consumer spending, because now the wealth effect is higher because of stock prices going up and credit spreads being tighter. All that should mean that we are delaying Fed cuts, and therefore we will probably have now a few more quarters of strong growth before we begin to see any meaningful slowdown.
Well, and I want to get to some of the slower points we are seeing maybe in terms of the U.S. economy. But having said that, first I want to ask, why put a time frame on it? Why say it's not going to happen this year, especially when there is still a fair amount of uncertainty about the economy and its behavior and how we kind of get towards the end of maybe a cycle?
Well, that's a good question, Carol. But if I, on my Bloomberg screen, type ECFC go, you get to see the economic consensus expectations to the U.S. economic outlook. And if you look at how expectations have evolved for growth in 2024, you have literally seen since the Fed pivot in the meeting on the 13th of December, that growth expectations for the U.S. economic outlook for 2024 have really gone up dramatically. And that's telling you that the consensus is beginning to come around to the view that maybe there is no near-term slowdown. And therefore the timeline really here is that if there is no near-term slowdown, and if we still have financial markets doing so well, then it is probably going to take a few more quarters before the Fed succeeds with getting inflation back to 2%. So the short answer to your question is that I still think that with financial conditions being as easy, or in plain English, with the stock market hitting new highs all the time, it's just really difficult to see the Fed begin to cut rates when you have the S&P at all-time highs every day. Because think about what that would do to the S&P, what it would do to financial conditions. It would ease them even more, and that would raise the risk for the Fed that you would get even more upside pressure on inflation, which we already have from wage inflation is still very high. You also have that NFIB survey of selling price expectations for firms, also still very strong signs of inflation in the pipeline. And finally, you also have a number of indicators across the board for labor markets, for what's going on in terms of ISM, prices paid, services, manufacturing, all that points to more inflation pressure still in the pipeline.
Torsten, you have a lot of conviction here. Your note this morning outlines 10 different reasons with charts about why you don't think the Fed is going to cut rates this year. But I'm wondering, what has to happen that changes your mind? What's the data point that could come out in the next few months that says, okay, I now think the Fed will cut this year?
Well, I think that we do need a change in financial conditions. There's a very academic debate where people often say, oh, monetary policy, it takes 18 months before it begins to show up in the economy when the Fed starts raising or lowering rates. But think about that time frame. We have already, since the Fed meeting in December, seen a very significant pickup in credit issuance, in IG, high yield and loans, and most importantly, IPO activity. Think about all the stories we have on our Bloomberg screen every day. IPO activity is coming back. M&A activity is coming back. Of course, this is going to have an immediate impact on hiring. It's going to have an immediate impact on the economy. So therefore, the transmission channel is no longer the 12, 18 months that the old textbook was saying. It is actually having a quite immediate effect. So I would say the answer to your question is, if we begin to see financial markets begin to slow down, then, and of course, if the stock market begins to come down from these all-time highs, then I do think that we should begin to revise our views. But where we sit right now, the tailwind is just really strong.
Torsten, you know this, and I'm sure you've had conversations with people that, the financial markets are not the economy. The economy is not the financial market. So I get what you're saying about the enthusiasm in the markets and the marketplace, but that doesn't necessarily mean that everything is good in the economy. We talk about the rising level of credit debt, consumer debt specifically. We have seen, still a strong labor market, and yet in terms of hiring demands, we've seen some weakness there. So there are some things that maybe can show the Fed that things aren't maybe as robust as they were maybe a few months ago, that there are signs of slowing that maybe give them the room to maybe cut rates at some point this year.
That's certainly a fair argument. We definitely have in the background that higher interest rates have resulted in an increase in delinquency rates on auto loans, an increase in delinquency rates on credit cards, in particular for households that have more leverage. Likewise, higher interest rates have also resulted in an increase in default rates for loans and also in a default rate for high yield. But note, this is mainly hitting higher levered entities such as highly levered and highly indebted households and highly levered and highly indebted firms, but those are still a relatively small part of the overall macro picture. The big picture still remains that in IG, companies are still doing well. In prime, when it comes to FICO scores for consumers, people are also still doing quite well. So with this tailwind from the stock market going up, from home prices now going up again, also likewise from credit spreads tightening. And remember also anyone who owns fixed income are getting higher cash flows. That's also supportive for consumer spending. But all those things on the scale still weigh more heavily.
Totally get it, Torsten. But isn't it fair to say that higher for longer is could potentially put the Fed at risk at overdoing it and create ultimately certainly tighter financial conditions out there, more stress on consumers that could ultimately play out in a wrong way? Like, isn't there like kind of the tipping point where you get a little worried about the Fed staying too high for too long?
Absolutely, and that's why, again, if I type ECFC, go on my Bloomberg screen, look in the upper right-hand corner, it will show you the consensus expects a 45% probability that we will have a recession in the next 12 months. 45% likelihood of a recession in the next 12 months. Think about how serious that is from the consensus. Is exactly saying, Carol, to your points, that there is a lot of worry that ultimately all the effects, the lagged effects of the Fed raising rates are going to come and bite us, and it will be slowing things down. But where we're sitting right now, the reality is just that is still now being pushed further out. And that's why I think we have to get all the way into 2025 before we begin to see the more meaningful impacts of the Fed raising rates. Essentially, when markets are now coming to the conclusion that we should see the stock market go higher, we should see credit spreads go tighter. If that's the case, that will continue to be a strong tailwind, both for people who own fixed income, but also for people who are in the stock market and seeing bigger wealth effects.
Torsten, are you ready to say that the next move from the Federal Reserve or the Fed could even raise rates at some point this year? Is that on your agenda?
I'm not. That's a very fair question. I'm not quite ready to see that. I saw on Bloomberg that Larry Summers was saying that there was a meaningful chance that maybe the next Fed move could be a hike. I think that the Fed will still rather just wait where they are. There's also something about doing that in an election year and doing that in a way that will send a really strong signal to financial markets. Why not just keep rates at these levels for a good deal longer and until the end of this year? And then once they begin to see that financial markets begin to settle down, inflation begins to settle down, and we do begin to see the economy slow, then they can begin to effectuate all the rate cuts that we now have been expecting literally since the beginning of last year. Because as you know, of course, all too well, we went all in the market and the Fed and the consensus into last year saying, oh, we'll have a recession. That turned out to be wrong. This year, they will cut 6 times, they will cut 7 times, and that also turned out to be wrong. So So again, we shouldn't make the same mistake we've made now for 14, 15 months.
Right.
Let's just look at the data, and the data is pointing still towards that this economy
So you're
is just
data
not
dependent
quite
like the
yet slowing
Fed,
down.
basically, right? Is that what you're saying?
My 10 charts in the note, Carol, shows you the data dependency exactly.
So what would change your mind to say that the Fed does actually have to increase rates this year, not just hold them steady?
Well, then
but
I do
keep
think
them...
we have to talk about some other things that you also always, of course, discuss so well, namely, then we might begin to think about, are there some risks in the regional banks because of commercial real estate? Are there some risks because China is slowing down at a fairly rapid rate? Germany, Europe is also slowing down. So could it be that global growth could also be a source of why we might get a slowdown later this year? It could also be more broadly geopolitical risks of all types of forms, including political risk in terms of what outcomes are of elections around the world, including in the US, could also be something that could either create upside or downside to the outlook. So I see those, I would in summary say those three things are likely the three risks that I worry about why we could have a faster slowdown, namely, again, the regional banks and commercial real estate. Number two is the global growth picture is not looking very good and slowing a lot faster than what we're talking about here for the US. And finally, geopolitical and political risk more broadly as uncertainty factors is also something that could potentially have an impact on the outlook for the next several quarters. But that's just not what we're seeing now.
Torsten, I want to go back to, and I know I think you were catching up with our Mike McKee at an event today, or talking with him, and he was sharing with us, just this whole idea of being, the Fed staying too long at the higher for longer party, and that the Fed, how much of a risk is it that they find themselves at that point where they over tightened, Mike reminding us, everybody reminding us that when recessions come on, they tend to come on really quickly. So how much do you think about that risk, and also, that 2% target? How committed do you think the Fed is ultimately to that 2% target? Is it time to really rethink that?
Yeah, no, this is all really important. I do think that we have had a pivot party. Financial markets have been partying after the Fed pivot, but I don't think that this pivot party was initiated by the Fed. This was not the Fed's idea that financial conditions should ease. They were simply observing that maybe they didn't have to raise rates as much as they thought at the September meeting. So they came in December and said, well, maybe we now can begin to think about later sometime in 2024 to cut interest rates. But nevertheless, financial markets overinterpreted that and literally had, again, a pivot party where they said, but that's green light for risky assets, that's green light for the stock market to go up, that's green light for credit spreads to tighten. And that tailwind that has been created might actually have surprised the Fed, because that tailwind is now the reason why the Fed may now have to swing the pendulum back in the more hawkish direction. As you hear from FOMC members in the last several weeks, they're now stepping back and saying, well, maybe we now have to wait a little while longer and we'll definitely not get a cut in March. So now many of them are saying, well, maybe we'll get a cut in the second half of this year. But that's what I'm saying. Maybe they'll have to push that further out if financial conditions to continue to be so easy.
Torsten, given what you're saying about what the Fed's going to do this year, do you think the equity markets and the rates markets are mispriced right now?
Well, I do think definitely that the Fed Fund futures, or SOFR futures as it's called now, of course, that they are pricing in too many cuts. I simply don't think we'll get these cuts because the economy is just simply not slowing down, period. And the other issue is, of course, that if it's not slowing down, then inflation is just not back at the 2% target. Several of the charts that I sent you this morning, they focus on that number of the leading indicators, both from manufacturing prices paid, services prices paid. Also, when it comes, and we saw that in ISM manufacturing prices paid this morning, continue to point to more upward pressure on inflation. Likewise, from the NFIB.
But we did see U.S. factory activity shrink at a faster pace in February. We did see that, which is concerns about some weakness in manufacturing.
Understood, but manufacturing is still only about 10% of the economy, so it's the service sector that still continues to do well. And there's a lot of discussion which is all about, oh, is this just a statistical artifact here in January in the statistics for inflation? But the problem with that is that then you also need to argue that this was also just some statistical fluke in employment, because non-farm payrolls at more than 300,000, that was a really strong number. It's also telling you that maybe there is some tailwind. So we'll see next Friday when we get the next non-farm payroll how strong the tailwind is. But ECO go on Bloomberg tells me we still have a tailwind on job growth. That makes me worry about still growth is actually still quite strong.
Torsten, very quickly, 25 seconds. So what's key for you and Jay Powell next week? Very quickly, just briefly.
Well, I would definitely expect him to swing the pendulum back in the more hawkish direction. I think that they have been surprised at the FOMC, how markets have been, again, doing their pivot party and rallying on the top of actually a relatively modest change in Fed communication. So they would probably now say, well, Fed communication has to swing back in the more hawkish direction after the dovish move they had in December.
Listen, so appreciate you spending some time with us. Apollo Global Manager, Chief Economist and Partner, Torsten Slok.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Well, the anti-woke movement is making its way into corporate speak. Tim, not sure if you've noticed.
I have to confess I have not noticed.
Well,
because I have not been reading all the 10Ks that our next guests have been reading.
What is wrong with you?
I don't read 10Ks at night.
Apparently not. Well, terms such as anti-racist and unconscious bias are being dropped on the editing floor when it comes to corporate filings at some very well-known companies, Tim.
Similar edits are getting penciled in at a wide range of companies as businesses, big and small, grapple with the conservative backlash against diversity initiatives. So writes the Bloomberg News team of Jeff Green and Simone Foxman. Both are Equality Team reporters. Jeff joining us from Detroit this afternoon. Simone here in the Bloomberg studio. Jeff, I want to start with you and just take a step back here. How did this whole thing get on your radar here? Because I think small changes within 10Ks are not necessarily something that people pick up on.
Yeah, well, one of the reporters mentioned it in one of the companies he was covering as an aside, and it wasn't that big of a deal in the company he cited, but I figured I would take a look, and the more I looked, the more I found, and some of these were terms that have been just standbys, boilerplate, if you will, for several years. And they were dropping out of the filings, and I thought that was really interesting. And as the list grew, it became even more interesting. And it wasn't just nights; it was also weekends to find all this stuff.
Not just nights and
Lucky
weekends.
you. Okay. Well, what specifically? Talk about some of these terms, because I feel like we've all been using them a lot over the last couple of years. Certainly coming off the pandemic, certainly coming off the death of George Floyd. Talk to us a little bit, dig a little bit deeper for us, specifically what they're dropping, what they're not writing about or including in any of those official filings.
Things like allyship, mandatory allyship training, that was one that dropped off. Anti-racist is one we highlighted because Uber didn't say we just want to not have racism. They said we want to become an anti-racist company. They said that for 3 years in a row. So when it dropped, it seemed notable. And that is one thing to be aware of. This is not like a company used a term 1 year and then the next year they didn't. Most of the time, this was 2 or 3 years of the same wording, and then suddenly it was changed. I used that criteria, in fact, Simone and I both did, to make sure we only looked for stuff that seemed to have been a pretty significant change. So this was something that we felt like was on purpose, even if the companies aren't admitting it.
Okay, so Simone Foxman, come on in here. If this is on purpose, why is this happening? What are the external or internal factors that are causing companies to change their language around this stuff?
Well, certainly we live in a political environment where there is a lot of blowback against these 3-letter acronyms, DEI and ESG. So there are people out there who are, looking at these companies and what they're doing and likely to raise a stink. But even more importantly is the affirmative action decision that the Supreme Court put forward back in June. And lawyers and consultants really tell us this has caused companies across the board to go ahead and look at their DEI policies and determine whether they're still legal. Because even though the affirmative action decision really catered very closely to schools and universities, everyone that we speak to really believes that there is going to be at least some crossover into the corporate world.
Well, Simone, the worry here, right, is lawsuits also about the company, right?
Absolutely.
And being targeted in an environment where companies are targeted by either politicians or just individual consumers and so on because of what they say are their woke policies.
And plenty of various firms have been under legal fire. I mean, you look at AFL, America First Legal. This is the organization that I guess is the front man is Stephen Miller, has gone after the likes of Disney for some of its policies, has gone after Edward Bloom, who was part of that decision, who was behind the Students for Fair Admission that sued Harvard and University of North Carolina, very publicly suing a lot of law firms that then themselves go ahead and advise companies, you need to be more careful about your language. So some of what we're seeing here is definitely companies just saying, let's narrow this in. Let's try and make things more vague. We don't need to put it all out there. And I should note, all these companies really are saying to us, we still are going ahead with our commitment to diversity and inclusion, but what they're writing in these heavily lawyered documents is just different, and we're trying to figure out exactly what that means going forward.
So pick up on that, Jeff, because that's what Simone ended with is what I want to ask you. Is there any indication that companies are actually acting different in terms of their policies or the way they're hiring or the way they're managing based on this language change?
Yeah, majority of companies seem to still be doing what they want to do, just trying to not make it so evident. And there has been some sloppiness. This is not just, some of this is actually good for these companies to take a harder look at what they've been saying and what they've been doing, because it has just sort of been free up until recently. You could kind of say and do whatever you wanted because it just was seen as doing good to do well and all those sorts of things. And now there's a little more scrutiny. But so far, it seems like where companies are actually changing their activities is on the margins, or with companies that really weren't very serious about it in the first place. Maybe they jumped in after George Floyd and they just kind of were trying to see what would work, and it wasn't really working for them, those sorts of things. But by and large, at this point anyway, it doesn't seem like there's a wholesale change in how big companies are approaching DEI. And it could be different in 5 or 10 years if the U.S. Supreme Court hears a case specifically about how businesses should operate.
I want to ask this to both of you. And Simone, let me ask you first. I mean, how willing were companies to talk about this with you guys? Or I'm assuming not much?
Extremely unwilling. It was some of them did comment. I should point out, and we have this in our story, we offer some detailed descriptions of some of the commentary they made, and plenty did say, this language changed our 10K, but it's still a policy we do. That said, I think no one really wants to stick their neck out on anything related to diversity and inclusion right now. We certainly heard that from companies.
Well, so Jeff, how about you come on in on this? But I mean, I feel like also net what you guys said is that even if they're dropping it from those official corporate filings, they're still pursuing their strategies when it comes to DEI. They're not backing off of them.
Yeah, it was kind of interesting. I got a sense after looking at close to 110Ks that there's also some sense to streamline them in general, like take some of the words out, have smaller statements about not just this, but other topics. And I also think, like in a couple instances, they took the information out of the 10K and maybe moved it into a specialized document that was more focused on the topic to basically maybe put it into a smaller audience.
Jeff, does this mirror what's happening in terms of other parts of companies right now? Like, are you starting to see this show up in any of the statistics that you track over at Bloomberg Equality?
Yeah, if you look at if there's a chart in the story, if you happen to have access to it, that kind of shows the trajectory of just mentions of DEI and diversity on corporate calls and in other sort of public-facing pronouncements is clearly on the decline as well, which is one of the reasons we anticipated it would show up in corporate filings.
Yeah, it is pretty worth checking it out at Bloomberg.com or on the Bloomberg to see what's happening. Just interesting to see how the pendulum swings in terms of companies, especially when it comes to what they put out publicly. And it'll be interesting to see ultimately where it all settles maybe over the next couple of years.
Also notable, I think it's happening during an election year, and people seem increasingly polarized as we head into November.
Yeah, exactly.
And this stuff is polarizing.
Yeah, absolutely, and can certainly sway maybe how people vote ultimately. All right, guys, thank you so much. Really appreciate it. Jeff Green and Simone Foxman of our Equality team, both reporters on that space. Just head to Bloomberg.com to read the whole story and check out more of their reporting. Also, you can find it on the Bloomberg terminal.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Good luck moving up, 'cause I'm moving out.
Well, Darien is a postage stamp of a little town. The richest in all of Connecticut's Gold Coast, it's packed densely with multi-million-dollar homes and is an unlikely spot for an office construction boom.
Not if you're moving out of New York and don't want to work there anymore. On a recent weekday morning, though, the rumble of excavators piling dirt high into mounds rang out across the downtown. Across it, they were making room for new shops, restaurants, and critically offices for finance workers who got a taste of life without the commute during the pandemic and realized they no longer want or need to make the hour-long train ride to Manhattan each day. So they're moving out of the city and said, I like it like being close to home, basically.
Those words courtesy of Nacha, Cattan, and Katya Porzakansky after a recent visit to Darien, which is undergoing quite a transformation right now. Nacha Cattan is Bloomberg News national desk reporter joining us from New York City right now. So Nacha, tell us a little bit about Darien for people who potentially, have not visited this town. What's it known for? What's it like? Who lives there? Where do they work? What's Darien all about?
Sure. Well, I'll tell you what it was like on a recent trip that we took, Katya and I. We got off the Metro North about an hour from Manhattan. And it really is just the cutest, quaintest town. You walk 5 minutes in one direction and you have a cute coffee shop, 5 minutes in another direction, and there's Blue Mercury skincare that just cropped up there. And then in yet another direction, suddenly there are offices for financial firms like Janney Montgomery Scott and Crestwood Advisors, and more are coming with the rebuilding of the downtown known as the Corbin District.
Kind of fascinating. First of all, okay, help me out here because it is kind of a tony little town. We all kind of are aware of it if you live in the New York metro area. Are they happy about the development?
Most people we speak with say that they are. We talked to Uncle's Deli, the owner of this small wood siding little building that's kind of remained while everything around it has changed. So all of the beautiful new but actually old style New England buildings have gone up around it. It's seen everything change, and what the owner was telling us is they think it's being done with taste, but he's a little bit nervous about just so much change happening so quickly, and he has some funny quips about how Post Road, which is the main street, used to be so tiny you could shoot a gun down Post Road and you wouldn't hit anyone, he also says, well, I used to see the Thruway through my window, now I see the Bank of America. So it's a bit of a conflicted feel for him. Well, but in general, good reaction.
Nacha, all of this is happening at a time when companies based in New York City are trying to get people back to the office. And it's all happening at a time when people are saying to themselves, wait a second, we weren't going into the office during the pandemic. It's kind of a drag to get on the Metro North and go an hour into Grand Central. So we're looking for lifestyle differences. Talk to us a little bit about the context here of what's happening big picture that could actually lead to some big changes in these towns.
Right. So we all know that during the pandemic, a lot of people fled Manhattan, moved to places like Connecticut, and now we have huge commercial real estate crisis issues, trying to get people back into the office in urban hubs. But in smaller towns, what we're seeing is, companies are realizing and developers are realizing that if they can attract people back in with brand new buildings or, highly amenitized, as they call them in real estate language, buildings near gyms and near coffee shops, right near the train station, right where they live, then the hope is that they will bring them in. And you're seeing a lot of money go into that kind of concept.
Nacha, Wall Street CEOs are calling and they're saying, no, we want you in the office. But it isn't, it's interesting, this contrast that is going on. Just got 30 seconds left here. Is it expanding? Is it not just Darien, but is it other communities that are also seeing an uptick in Connecticut where a lot of, to be fair, financial folks live rather, that maybe we're seeing it also boom, the boom going on in other towns? And just really quickly, if you could.
Sure. Westport and Fairfield are two other towns where we understand there's more companies sort of luring offices there. But then there's also Greenwich, of course, and Stamford. You can't leave those two out. Those are the big hubs for financial firms.
Really interesting story. So appreciate it. And I believe it is still the most read story on the Bloomberg, as it has been all day. Yep. So well done, and certainly getting a lot of attention. Nacha Cattan, thank you so much. Bloomberg News national desk reporter joining us in New York City.
I'm driving in my car, I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, everybody, TikTok. Just about 18 minutes left in today's trading session. Charlie breaking down the trade for you, just rolling over in terms of the equity rally. But we're up about 1% still on the NASDAQ. Big reason why, Tim, we talked about it earlier, Fed Governor Mr. Waller talking about maybe the Fed in terms of buying, I guess, on the shorter end of the yield curve here, or shorter term treasuries. We've seen yields come down quite a bit.
So are people not paying attention to what Torsten Slok has to say?
No, because he's saying the Fed doesn't have to cut rates, and we're seeing lower rates today.
I know, that's what I'm saying.
So they're not listening.
That's what I'm saying, yeah.
Sorry, I do listen to you.
Sometimes.
I'm in a little bit of a Friday mode. Can you tell?
Hey, let's see what Dave Harden has to say about all this. It's time for Drive to the Close. For that, we go to Dave Harden, who's CIO at Summit Global Investments. He joins us from Utah. Dave, good to have you with us. How's the skiing out there in Utah right now? You get any of the snow that California is set to get this weekend?
Absolutely. And we're looking forward to having you out. But the snow looks great, and we're enjoying it, that's for sure.
That's good to hear.
What are people talking about more, the snow or what the Fed's going to do?
Well, that's a great question. In the office, the Feds. Well, maybe not. Behind my back, maybe the snow still.
All right. What is the important conversation? Because we know folks say, listen, we're longer term for investors, blah, blah, blah. We don't really care about the day-to-day gyrations and swings. But having said that, you got to kind of sometimes tinker around with portfolios. So what is the smart conversation around the financial markets and investing right now in a market that has really bounced back, certainly on the equity side, in a strong way?
Well, I think there's three conversations. One is centered around risk. The market, because we don't really know exactly what the Fed's going to do besides support everything, the reality is that that's generating a lot of the comments around risk. And the better you understand the risks in your portfolio, I think the better your portfolio will do for you. So I think understanding those risks and diving into those risks is probably paramount. Behind that, though, we have AI and technology, right? NVIDIA stole the show, if you will, with their earnings. They've kind of reignited that rally, and we're seeing it today, up, like you said, about 1% on the NASDAQ. The last one there with the three would be the Fed itself. Everybody was kind of thinking maybe the Fed's taken out of the driver's seat, and the reality is clearly they're not, and they don't want to give it up. They want to stay in that driver's seat. They're looking at the financial conditions, and they really have this ability to cut rates if they need to, cut rates with weakness. And like you said today, looks like they've done that without even cutting rates. So the Fed's really in the driver's seat. And those are the three discussions I think that are most important right now.
Okay, so talk a little bit about what the risks are that are out there, because you said you need to understand the risks, but what are some of those risks?
Well, for example, let's take utilities today. And I know it's just one day, and a day doesn't make a market, right? It doesn't make a portfolio over time. But utilities today are really, really suffering. So people are looking at utilities and saying, hey, I want to invest in utilities. I want to have safety in my portfolio. The reality is that over the last 2 years, utilities have not brought in the safety that people maybe in the past have experienced. So you have to look beyond the kind of the notion that the standard that it's been in the past. What are the risks in your portfolio? What are the yield risks? Meaning, how does inflation impact your portfolio? And right now, it's significantly impacting utilities and financials. We're seeing it in both those sectors. So understanding specifically, another thing that people don't look at is company-specific risk. What's going on with the managers and with the CEO and the C-level suite of your portfolio, or what's happening behind the business risk of your portfolio. These things I think need to be explored within a portfolio management team. And that's one of the things we do here at Summit Global Investments.
I just want to make sure I understand you right. We are seeing utilities, the worst performers in the S&P 500 today, but they're down possibly because of what's going on just with Xcel Energy and the risks around the worst Texas wildfire in history, and questions that arose yesterday in a filing from a lawyer that, spread concern about whether or not Xcel could be held liable for that. So are you saying utilities as a whole, or because we need to, or do we need to remove Xcel's performance yesterday and today from that?
I think you do need to remove that individually, but utilities tend to have this issue, right? We had Southern Cal doing the same thing. We've had some of these, not Southern Cal, excuse me. I take that back to all the Southern Cal shareholders. But we've seen this.
You're talking PG&E, right?
Wildfires before. Yes, exactly. We've seen this with utilities and wildfires before and the risk around them. But the concept's the same. And so, yeah, remove that performance, but utility as a whole has still lagged considerably from where the safety has been in the past. So I think that you're absolutely right. Every company needs to be evaluated. And a company like Excel and the chance that it may be liable for this large fire, it doesn't have as much legal damage as it looks like to some of the other fires with deaths and destruction, but it still has plenty. And so there's a lot of risk there.
Hey, one thing I want to ask you, because we kicked off our broadcast at 2 p.m. Wall Street time with Apollo Management Chief Economist Torsten Slok. It's one of our most read stories on the Bloomberg today. And he basically says the Fed doesn't need to cut rates in 2024. He said because of a rise in underlying inflation, it'll prevent the Fed from doing so. And he pointed to some of the growth that we continue to see in the economy. What is your Fed bet, and what investment most is that impacting?
So this is the tug of war, right? Because if the Fed doesn't cut, how does that affect the technology and the AI and et cetera? I think people want the Fed to cut from a standpoint of, I want my portfolio to go up. And they think that if the Fed cuts rates, that their portfolio will rise. That's the kind of notion out there on the street. I think that it's going to be higher rates for longer. I am in the ballpark that some of the inflation numbers, not all of them, are a lot stickier, especially with employment, a lot stickier than people really realize. So I don't see the inflation coming down as quickly as people believe. The issue really falls not in necessarily will the Fed cut rates or not. I think another thing is, will they step in if there's any weakness? And I think the market also believes that, you know what, even if rates aren't cut, if there's any real weakness in the economy, the Fed will stop. The Fed will step in. So that's really where this backstop, it's kind of the old notion of don't fight the Fed. That's still at play right now.
Are you seeing any of that weakness out there right now?
Oh, sure. Absolutely. I think that you always got to be cautious that you're a little bit too optimistic. I always say to people, check your ego at the door a little bit. Don't get over your skis. I think you always need to take profits where you have some. And there's some really, really good returns right now in a lot of the AI and technology sectors. And I wouldn't be surprised at all if you see over the next couple of weeks a little bit of a reprieve there a little bit. But, over the next quarter, I still think that tech wins out for sure. If you had a bet between tech and utilities, I'd probably go with tech.
All right, going to leave it there. Hey, listen, thank you so much. Dave, have a good weekend. Dave Harden, he's CIO of Summit Global Investments out there in Utah.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.